Listen up, folks. It's time to talk about the stock market. Stocks? That's for rich people, right? Wrong. The stock market is for everyone. It's a powerful tool for building wealth over time. When you buy stocks, you're buying a piece of a company. As that company grows and makes money, your piece becomes more valuable. It's like owning a slice of the American dream. And the best part, you don't need to be a Wall Street hotshot to get started. The stock market can be volatile, like a roller coaster. But over the long haul, it tends to go up. Investing in stocks is one of the best ways to grow your money over time. But where do you start? How do you pick the right stocks? Don't worry, I've got you covered. It's called mutual funds, and it's your ticket to the stock market party. All right, let's break down mutual funds. Think of them as a big basket of stocks. When you buy into a mutual fund, you're not just buying one stock. You're buying a little piece of many different stocks. It's like going to a buffet instead of ordering a single dish. A bunch of investors pool their money together. Then a professional money manager takes that pool and invests it in a variety of stocks, bonds, or other securities. The fund manager's job is to pick investments that will grow over time. The beauty is, you can choose a fund that matches your goals and risk tolerance. The SEC keeps an eye on them to protect investors. Listen up, newbies. Mutual funds are your best friend when you're just starting out. They take the guesswork out of investing. You don't need to be an expert in reading financial statements or analyzing market trends. The fund manager does all that for you. Another great thing about mutual funds is that they're accessible. You can start investing with as little as $50 in some cases, and many funds allow you to set up automatic investments. This means you can invest a little bit each month without even thinking about it. Mutual funds also offer professional management. These fund managers eat, sleep, and breathe the stock market. They have access to research and tools that most individual investors don't. Lastly, mutual funds offer something called liquidity. This flexibility is a huge advantage, especially for beginners who might be nervous about locking up their money. Section 4. Diversification, the eggs in many baskets approach. All right, folks, let's talk about one of the most important concepts in investing diversification. You've probably heard the saying, don't put all your eggs in one basket. Diversification is spreading your money across different investments to reduce risk. If you put all your money in one stock and that company tanks, you're in trouble. But if you spread your money across many different stocks, you're less likely to lose everything if one company has a bad year. Mutual funds are great for diversification because they do this automatically. When you buy a mutual fund, you're instantly investing in dozens, sometimes hundreds, of different stocks. It's like buying a slice of the whole market pie instead of just one ingredient. Over time, it can help smooth out the ups and downs. For beginners, that balance is crucial. Section 5, your step-by-step guide to buying mutual funds. Okay, you're convinced, but how do you actually buy them? First, open an account with a brokerage firm. Many big names like Vanguard, Fidelity, or Charles Schwab offer mutual funds. Next, choose your mutual fund. Index funds are often a good choice for beginners. Once chosen, buy your fund.